Welcome to XYPN Radio, where your host Alan Moore brings you into a community of fee-only financial planners who want to profitably and successfully serve Gen X and Gen Y clients. If you're ready to get the knowledge you need from leaders in your field, learn from forward-thinking advisors, and take action on your own goals, XYPN Radio is the show for you. Here's your host.
Hello, and welcome to this episode of XYPN Radio. I'm your host, Alan Moore, and I'm excited to have XYPN member Linden Cornett back on the show today. Linden joined us back in episode 72 and is back now 2 years later to give us an update on her firm. She made a big decision after year one to heavily restrict the growth of her firm, committing to her family that she would only take on 5 new clients per year and even agreeing to pay them if she violates that commitment. She still works part-time for Intel, which was her career prior to starting a financial planning firm. So it was interesting to hear how she's balancing life with her husband, 2 kids, a business, and a part-time job. She specializes in working with Intel employees, no surprise there, but also retirees. And we talked about her extensive research into the new tax laws that passed last year and her leveraging of donor-advised funds to help her clients more efficiently donate money to causes they believe in. Linden was gracious enough to share her 2016, 2017, and 2018 revenue and expenses. So listeners can use this as an example of how you can grow a firm slowly, but still increase revenue over time. This is a great update, and you'll want to listen all the way through to the end when she shares what she's learned in her 3 years in business. XY Planning Network's annual benchmarking study is out. Are you curious about the average number of clients XYPN members get in their first year, or how successful niches really are? To answer these burning questions and more, we've again enlisted a professional research firm to complete our annual benchmarking survey. Get your copy hot off the press and discover vital statistics such as the median advisor revenue by years in practice and sources of firm growth from referrals to blogging, social media, and more. Head over to xyplanningnetwork.com/study to purchase your copy. You can find any of the additional resources that we mentioned during the episode at xyplanningnetwork.com/174. Also, be sure to go to xyplanningnetwork.com/VIP to join our private group just for XYPN Radio listeners. It's a community of advisors we've all been looking for that's there to provide support when we need it the most. Best of all, it's free. I encourage you to check it out. Again, that's xyplanningnetwork.com/VIP. Without further ado, here's my interview with Linden. Hey, Linden, welcome back to the show. Thanks so much for coming back on.
Hey, Alan. Great to hear from you. How you doing?
I am awesome. I appreciate you coming back. For anyone who has not listened to every episode of XYPN Radio, because I know there are 1 or 2 of you out there that have skipped a few episodes, we had Linden on back on episode 72. So if you go to xyplanningnetwork.com/72, you can hear the first interview, which, because this is episode 174, I believe, that was exactly 2 years ago. And so if you want to get, in this interview, I don't think we're going to talk too much about career history and that sort of thing. So if you want to get caught up, go back and listen to episode 72, and it will give some foundation and sort of background that we're not going to dig into like we normally do. But instead, we're going to really focus on sort of how the last 2 years have gone and just sort of where things are at. Because remind me, when did you actually launch your RIA?
I launched my firm in January of 2016. So It's been coming up on 3 years now. It'll be 3 years in January.
Perfect. So so that, November 2016 interview would have been, right at the 1 year mark. And so this will be right at the 3 year mark. So just by way of sort of, again, I'm going to let listeners go back and listen to sort of where things were at, but a couple of the points that, that want to talk about is just sort of where things are at compared to, where you were at whenever we recorded last. So can you talk to me a little bit just about the growth of the firm? Because I know that was a big part of your growth. You just had explosive growth. If I remember right, you had 18 clients in your first 10 months in business, and sort of how that has grown for you. Still taking 18 clients every 10 months, and you're at 70 now, or whatever that number would be?
Definitely not. So that first year, as you mentioned, I did take 18 clients and had to have a heart-to-heart with my family, my husband, my kids at the end of that year. And they basically told me I was working too much and I needed to slow down. So I made an agreement with them that I wouldn't take more than 5 clients per year going forward. I actually put my money where my mouth was, and I promised to pay them a fine if I were to take more than 5 clients a year going forward.
How much do you have to pay? What does a client cost you?
Yeah, I have to pay my husband $1,000 and each of my kids $100, which is a fortune to them.
Wow. That's a Warren Buffett thing right there. And when I read his documentary, it's sort of you have to read the book to understand, but I guess I should say biography, but you have to read the book to understand. This is going to sound weird, but his thing was weight gain. He was really concerned about gaining weight. So he would write a check to his kids dated like 3 months in the future. And if he gained a certain amount of weight, they could cash the check, and they never got to cash the check. But anyway, that makes him sound like a terrible person. But anyway, the book makes it sound a little better. But that's a really interesting way of handling it. Where'd the number 5 a year come from?
Well, 18 was obviously too many, but I didn't want to stop taking clients completely because I found that I really enjoy that process of kind of onboarding a new client, figuring out, taking their mess and their chaos and turning it into order. So 5 a year just seemed like approximately 1 a quarter, which is kind of my target at this point, is to take either 0 or 1 new client each quarter. I'm fine with 0, but I'm trying not to take more than 1 a quarter unless there's some sort of extraordinary circumstance. And that's for ongoing clients. I am still doing a bit of hourly and project work, and that's less of a commitment. So I'm also willing to sprinkle in a couple of those as they come up.
When so out of curiosity, if you lose a client, do you get to replace the client, or it's just like 5 new clients? It's 5 new clients, because the new clients are where, I spend a lot of time with new clients, probably 30 to 40 hours during the first 6 months. Wow.
So that's the part that, is a big burden on my family, because I'm having meetings, I'm doing a lot of work, I'm working on the evenings, the weekends, and so on. I am still working part-time for Intel. So this is not my full-time 40-hour-a-week job. So I do need to kind of be protective of my time. And that's kind of where that comes from.
What is your sort of target in terms of number of hours that you're working in the financial planning firm?
Well, let me start by telling you kind of my schedule with Intel, which is that I'm working part-time for about 6 to 7 months a year. So during months when I'm working for Intel, I'm trying to work, say, 20 to 25 hours a week on my business. During months when I'm not working for Intel, so when I'm taking that unpaid time off, then it bumps up to, say, 25, 30, 35 hours, or really whatever the situation demands.
Okay.
But I'm trying not to kind of ever get up to like the 40, 50, 60 hours a week on the business at this point.
So combined, is that around full time then? How many hours? What does part time at Intel mean? And how do you get a 7-month gig? That's an interesting contract.
Yeah, no, I mean, I've been there for 20 years now. So I still am officially a full-time employee or a part-time employee. I officially work 3 days a week all year round. But then I take unpaid leave of absences that are, 1 to 2 months at a time, a couple times throughout the year. And the reason I'm able to do that is just because I've been there so long. So I have so much history and experience and kind of institutional knowledge that it's still worth it for them to have me there, even if I'm not full-time. I don't think anybody could jump in and negotiate this schedule as a new employee, but because I've been there so long, I mean, I basically told them, I'm ready to leave. So let's work something out that works for both of us. And if you ever need me to leave, no problem. If I decide I need to leave, I'll let you know. But this is the schedule that I'm willing to work, basically. So I work during the months I'm working for Intel. I work 3 days a week, Tuesday, Wednesday, and Thursday. And I go to the office 2 days a week and work from home 1 day a week. So I do all my client meetings on Mondays and Fridays. And then I also have 1 evening a week where I do client meetings. And then I will occasionally do a Sunday afternoon meeting if that's needed for my client schedules.
So why continue to work at Intel? I mean, you could easily just take on a few more clients. Well, I guess I don't know the numbers, but maybe you could take on some clients to replace that income if you wanted. Is it just a financial decision, or is it just you love the work but just don't want to do it full time?
Well, it's a couple different things. First, I have awesome benefits through Intel, health insurance and all that. Secondly, I mean, I am still, even at this part-time schedule, earning way more from Intel than I am from my business. So it's not just a few more clients. I'd have to, probably triple my business to make up for what I'm earning. And the third is that now that I am a part-time employee for Intel, the type of work that I'm doing is changing. I'm doing a lot more kind of mentoring and consulting, just kind of helping other people be better at their jobs. And I do find that rewarding. So at some point, it may make sense for me to leave. I don't see myself making that decision just because they're paying me so much for so little work at this point, and I get the great benefits. But I'm, mentally ready for that time to come when, either they decide they don't need me anymore, or for some reason for my family, it just makes sense not to do it anymore.
I mean, huge shout out to you that, companies like Intel, big or small, companies spend money and invest in people when they see value. And so the fact that they see enough value that they've got it structured that way that it works for you and it works for them, it's a testament to the value that you're bringing that company, which is awesome.
Yeah. And I've been really lucky to have great managers and coworkers who are willing to work with me and figure out a way to, make this work for everybody.
So, I guess not everyone is in the position of being able to do that, particularly if you're currently working at a financial planning firm. Asking for this type of work schedule would be challenging at best. But for our career changers that are out there, just recognize that try to be creative, and your boss manager may not be flexible on that. But, if they see value in having you there, then, and you've been there a while, who knows? It's worth a conversation just to see, because, from an income standpoint, from a benefit standpoint, from a just overall financial and family situation, maybe it makes sense for you to consider.
Yep. And then to answer your question, last time we talked, I think I had 18 clients and maybe 21 million of assets under management. As of now, I have 26 clients. My total assets under management is somewhere between 35 and 40 million. I don't have an exact number for you because I'm actually a multi-custodian. So I'm managing client assets at 5 different custodians. So it's not really that easy for me to quickly run a report on exactly what my assets under management are. I only do that when required, but it's somewhere in the 35 to 40 million range. And of those 26 clients, a good chunk of them are not paying me. So 8 of them are family members who are, not paying me right now. They would if I asked them to, but I'm just not asking them to. I've got 14 kind of full service, what I call full service clients, where I'm doing comprehensive planning and investment management for them. One client that I'm still doing planning, but not investment management. So they handle their own investments with guidance from me. And then 3 of those clients are, project or hourly clients that I've had within the last year.
So a couple of things I want to talk about there. So you went from 18 clients, 21 million, to 26 clients, 35 to 40 million. So was that because was a big chunk of those first 18 some of these free family members, or are you just like starting to find clients with just larger assets that are coming on board?
That original 18, I think 6 of them were those free family members. So
Okay.
The other 12 were paying clients. Of my new clients since then, 2 more of them were the free family members. And I have taken on, a couple of clients that have, fairly significant assets. I would say, my average client at this point has between 1.5 and 3.5 million in total portfolio. So they're relatively large, affluent clients, but I don't have any minimum. So, I can take a client at any asset level, but I do have a minimum fee of $3,000 per year at this point. So that doesn't really make sense for somebody who doesn't have either the income or the assets to support that.
Absolutely. So talk to me about working with family members. So I worked with a few family members. I did charge them. So, but I guess there's 2 components to this. One is, people really struggle with the decision of whether or not to work with family. Because I think, some people have been burned by that. And then 2, whether or not to charge. So let's talk about the first piece. How do you make the decision to work with family members, and how has that gone from are they implementing your recommendations? Are they following your advice? Do they treat you like their financial planner, or do they treat you like, the cousin or the sister or the daughter that, just gives them some random free advice and take it or leave it?
So I guess I should mention that for the kind of free family members, I'm not really giving them my full financial planning service. It's more like I'm just handling the investment management for them, basically just because it's easy for me and it's not easy for them. So they're not running through like my whole financial planning. They're not on my software. They're not getting my full kind of like, all of the services that I usually do. So they do call me when they have questions, but actually a couple of them, I actually have them paying other financial planners to do the planning piece of it.
Interesting.
And I just do the investment management for free for them. And I coordinate with their planner because I don't want to, like, investment management is one thing, but I don't really want to do planning for free because that's where the real work is.
Okay. That makes a little more sense. Okay.
Yeah. The decision about why to do it, I don't know. I just felt like it was, I have a good relationship with them. I don't do market timing or, individual stock picking or anything where I feel like it could burn me with my relationship with them. Like, I'm very clear up front, like I do broad-based, low-cost index fund investing according to your, we set up an asset allocation according to your risk tolerance. We agree on the risk tolerance. I give them a proposal for how I'll invest it. And then from then, there's just not that much discussion about it. Occasionally I'll get a phone call or an email of, what do you think about buying this stock? Or what do you think about the market? And I answer those, but it's not like it's a huge burden on my time.
Just out of curiosity, what do you use to assess risk tolerance? Is that technology or do you have your own assessment?
I use a combination of items. So I really like the philosophy of looking at it kind of from a multifaceted perspective. So willingness, need, ability to take risk. And I also take some valuation into it as well, market valuation. So I use the Vanguard risk tolerance questionnaire to figure out the willingness to take risk. And that sets a ceiling on the equities that I would consider for the portfolio. And then I do some analysis of, from a financial planning perspective, what's the minimum equities that they would need to meet their goals? And that gives us kind of need to take risk. And then from an ability perspective, that has more to do with their time frame and their current income when they expect to actually start taking money from the portfolio. And then I look at all of those things together to kind of set the, min and max equities that might make sense for that particular household. And then we also look at kind of current market valuations using PE10 and things like that to say, okay, well, the maximum equities that might make sense for your situation is, say 70%. The minimum risk that you need to take to meet your goals is 50%. And then we'll have some, trigger points based on market valuations to move potentially between 50 and 70% over time. But that's all kind of set up in advance. It's not based on emotion or anything like that.
Okay. Very interesting. Yeah. Risk tolerance is one of those things that there are a lot of ways that advisors assess risk. I mean, sometimes, like you said, it's just the, how much risk capacity do you have in terms of just psychological, but then, again, starting to evolve into, how much do you actually need to take? Because, you may have a very high capacity and have no need to take risk. That is easier, I think, than the opposite when you have no capacity for risk, but you need to take some in order to accomplish your goals.
Yeah, in that case, you need to adjust your goals, right?
Right, exactly. Or you have, partners that have very different risk tolerances, all very interesting conversations to have.
Right. And I have each of the members of a household go through this exercise individually. And I found most of the time they're pretty closely aligned, at least in my clients, but a couple of cases where they aren't. And then in that case, we talk about it. We often go with the more conservative client, or the accounts that are in the name of the more conservative client are invested more conservatively. And the accounts that are, in the name of the more aggressive client or are invested more aggressively, but still meeting the overall household allocation.
Mental accounting is a beautiful thing. And that, because as an advisor, we're looking at the holistic, the household level financial plan and all the investments. But the individual client, they probably see their investment returns in their 401k when they log into their 401k portals. So having that be a little more conservative for the more conservative partner, and having, the rest of the portfolio sort of amped up a little bit in order to compensate for whatever level of risk you need. Like that's a fine way to do it. I will say running reports for each partner, I have seen that be just sort of an operational challenge, because you don't want to run a household report because it doesn't exactly match the way you've done that. So have you run into that and actually like running reports for each partner, or are you?
No, I only do reporting at the household level, but I don't do performance reporting at all. The only thing that I provide for my clients is a quarterly snapshot of their portfolio as a whole. And what I talk about there is not performance, but it's balances on each account, where we are from an asset allocation perspective, where we're investing new money, any, potential, where we are in terms of needing to do rebalancing, things like that. So I'm not focused on performance with my clients. The main kind of metric that we look at is net worth change from year to year. So I do like a full net worth analysis once a year on the anniversary of whenever the client joined. And then at that point, we look at, what's changed year over year, both from the perspective of their investments, but also debt, home equity, whatever else they have, things like that.
Are you tracking their net worth in some particular system or just doing it in Excel to sort of show, net worth changes over time?
Yeah, so I use Right Capital, and all of their accounts are linked up there. The aggregation works most of the time, but there are a couple of, financial institutions that just don't play well with aggregation. So for those, I'll just put in like a manual snapshot once a year or quarterly or however often we decide it's needed. But then what I do is I pull that report out of Right Capital and put it into, I don't use Excel, I use Google Sheets and Google Docs for everything. So once a year, I'll pull that full report out of Right Capital, drop it into Google Sheets, kind of with a separate tab for each year, so they have all the details, and then kind of a analysis page that shows the year over year changes, percentage increase, dollar increase, things like that. And my clients find that really useful information, and they're often really surprised by the numbers that they see there.
Yeah, that was one of the, I think, more fascinating things and really rewarding things that I experienced with especially younger clients was when I sat down in the, sort of the financial plan presentation part of the process and showed them their net worth, because no one has ever looked at their net worth before. But they could if they went out and figured out all the numbers, but they just don't think of it in that way. And to be able to say like, hey, you're on track and here's proof. Yes, you're obsessing over your student loan debt and yeah, that sucks right now and it's pulling down your overall equity. But like, look here, like you actually have a positive net worth whenever you look at the whole picture, and being able to see that go up over time, which for younger clients is not driven by market returns. It's really driven by savings. For your retired clients, yeah, it's going to be market returns and spending patterns, but they actually have a lot more control over their net worth than sometimes we give them credit for.
Yeah, definitely. I agree.
So you mentioned earlier being multi-custodial with 5 custodians. I remember having 2 custodians and wanting to quit. So talk to me about just like the decision to have 5 custodians, and then we'll talk about how you're managing to have 5 custodians. So I guess what led you down this path?
Okay, so the vast majority of my clients have accounts directly at Vanguard. So that's about 80% of my client assets are at Vanguard. That's where I've always done my personal investing, and it fits really well with my kind of low cost and, keep fees to a minimum philosophy. So that's where it made sense. So all my clients' taxable accounts and IRAs are at Vanguard. And that's what I did from the very beginning. They give me access to transact on those accounts for them. So I handle all the investment management with a LPOA. But they're basically just retail Vanguard accounts.
I was going to ask how you're managing that. So your LPOA allows you to log in, but you don't have like a central data feed for all of that information.
Well, when I log in, I see everything. Yeah.
Oh, okay. So your single login lets you see multiple clients? Well, I guess maybe my point is going a different direction. So yeah, do you have a login per client, or do you have a single login that gives you access to all of your clients?
I have a single login that gives me access to all of my
I didn't
clients.
realize they did it that way. Very cool.
Yeah. And they're just giving me personally access to their account. There is another way to do it where you set up kind of like a firm account and then clients can give access to the firm. I didn't go down that route because it looked like it was way more trouble to actually have the client give access. You had to do it with a paper form, and I'm not really ever planning to expand or hire people or have more advisors. So it works fine for me. But I completely, I'm very open about the fact that this is not necessarily a scalable model that would work for a firm that wanted to, grow and have a large number of clients. So that's my first custodian. I added on TD Ameritrade because I had a client who had a 401k where they could get a self-directed brokerage window through TD Ameritrade, and they wanted me to manage that account for them. So I do that. I've also opened a couple more accounts at TD Ameritrade, but that's a really small percentage of my assets at this point, 1% or so. I do think that a couple of my clients who have HSAs might eventually open up like a trading window in their HSA to allow me to manage that at TDA. I've also got some individual 401k plans set up there for some self-employed clients because in a few ways, it's better than the Vanguard individual 401k plan, mostly in that you can set up the account using DocuSign instead of having to send in a paper form. So if time is of the essence, then that makes sense. I've got some clients with a good chunk of their assets at TIAA, and they wanted me to be able to manage those for them, and they couldn't necessarily roll them out that easily because they're in investments that are not entirely liquid. So I became a TIAA advisor earlier this year. Again, it's not a huge percentage. It's maybe 2 to 3% of my total. I have a client who has a simple at Schwab, and her employer won't allow her to move it to Vanguard. They only support Schwab. So I agreed to sign up to be able to manage her account at Schwab, and that's just a simple LPOA. It's not like I don't have a firm account at Schwab. And then the final one is Fidelity 401k. So a lot of my clients are Intel employees. I still work for Intel part-time, as I mentioned. And all of Intel's employee plans are at Fidelity. So there's 401ks, there's deferred compensation plans, there's a profit sharing plan, so on, managing or at least viewing pension benefits, things like that. So another approximately 15% of my client assets are there at Fidelity.
I'm exhausted just thinking about how you're managing all this. So do you have a central system that rolls everything up, or is it pretty, each custodian gets managed in its own way?
So I manage everything at the household level. So for every client, I pull in all of their accounts to my, portfolio management software, and the majority of that is all automated. I do need to go and look at every kind of household periodically, which I look at every household's portfolio at least once a month just to see what needs to be done. But that's for the most part, fairly automated. I don't have like one centralized system where I can just go and look at everything very easily. So it's certainly not ideal from an efficiency perspective, but this is just where my clients are. I loved what Rebecca Connor said in the episode a few weeks ago, where she was like, I just want to meet my clients where they are. And this is where my clients are. And I really want to give them what I feel like is the best solution or service for them where they are, not kind of like trying to pigeonhole them into what's more efficient.
Yeah, it's a great point because, this is a big decision that, ultimately you can't do some of the work that you're trying to do. Like, it's not like you can just move the assets, move the simple and eliminate a custodian. So it's either you're providing the service or you're not. Most advisors, I would say, will just say, hey, I'll tell you the trades to do, you go do them, but they're not going to, get a relationship with a custodian, a login for one account. You're choosing to do that. I think that's, totally fine.
Yeah. And I did do that for the first year with that client, with that simple, and she just didn't have time to do it.
All the trades were done exactly as you would have done. And it's interesting because, decisions like that, I feel like when you're solo, you can get away with it, right? If you go to scale and you bring on 3 to 5 advisors, it's just a nightmare. When you're big, you're going to have 5 custodial relationships and you've got all the systems and processes to manage. So it's sort of this interesting, like, you don't want to do it when, if you were going to scale to big, just because that middle ground I feel like would be really tough. But, you said earlier that, that's not your goal, and that you want to be able to work with your clients where they're at. And so therefore, you end up with 5 custodial relationships, and maybe we'll find a way to add a 6th to your plate one of these days.
Definitely. Actually, Intel just switched over to a new provider for all their stock compensation. So I may end up having a relationship with E-Trade at some point as well.
What you said, E-Trade, didn't they just get bought by, who bought them? TD or someone bought them?
Did they?
Trust Company of America,
Oh.
maybe. I think it was TCA bought E-Trade. So anyway, yeah, just to complicate your life further. Sorry to whoever bought E-Trade. I'm losing it. I do want to circle back on one thing that you mentioned earlier, and that was around part of the decision to not grow fast is how much time you're spending with initial clients. So you said 30 to 40 hours in the first 6 months. Thinking back, I think I spent around 12 to 15 hours with a new client. So talk to me about your process for new clients and just like where that time is spent, because clearly you're going very deep into the planning relationship, but I would say that that's probably higher than most advisors. So you're doing something a little different. So I guess, can you walk me through that process and sort of where those hours are being spent?
Sure. So the way that I usually start working with a new client is we'll kind of start with your kind of standard, discovery meeting where I have a series of questions that I run through talking about where they're at, what their goals are, et cetera. I mean, that's, fairly standard. The way I think of it is I'm going kind of broad, but not very deep in terms of just kind of figuring out where they're at, what they have, where they are today. And then after that meeting, I'll usually ask them to upload a bunch of documents, like investment statements or tax returns, pay stubs, things like that. And then basically what I do is prioritize on a per client basis, which planning topics are most important or most urgent for them. So I have a whole series of topics that I want to cover during the first year with a client, but every client kind of has a different need in terms of what they care about. And then once we kind of figure out, what's urgent, what's important, we'll kind of go through those topics at a pretty deep level, one by one, until we cover all of them. So for most of my clients, the thing that they want to look at first is investments or taxes. So that's where most of my clients come to me is either they paid some huge tax bill and they want to figure out how to stop doing that, or they've got 15 to 20 different investment accounts all over the place. They don't really know why they're invested the way they are. And so they want to, have something a little bit more organized around that and usually to have me handle it for them. So I go through a process of creating an investment plan for the client. As I said, this is at the household level and I do, asset allocation across all of the clients' accounts. And then also most clients need to do a bunch of consolidation. So they've got small accounts all over the place. So we kind of work through a step-by-step plan of exactly what to do in terms of getting their accounts where they need to be. And, this is the kind of the end result of this is like a spreadsheet, which is in Google Sheets, which shows all of their accounts and all of their investments kind of at the asset class level, and then how we fill up those asset classes with the investments that are needed. And then also a written investment plan, which talks through where they are today, what they're paying in expenses, what I'm recommending that they move towards, how we're going to handle new contributions, how we're going to handle consolidation, what we're going to do from a employee stock perspective, because a lot of my clients who come to me as Intel employees have a really large amount of employer stock. And we need to make a plan for how to diversify that over time, while being careful of taxes as well, how we're going to handle rebalancing, et cetera. So this process is, possibly more involved than usual because I'm not just saying, okay, here's what you have available to invest. Here's my model. You're going in my model. It's really custom for every client. And I do a lot of education for the client as well. I have, a slide presentation that I run through. It takes, 45 minutes to an hour where I'm kind of teaching them all about what investments are, all about factor-based investing and all the different aspects to make sure that they really understand why we're doing what we're doing. So that on the back end, when the time comes to actually implement something, they already understand it and we don't have to have, confusion or fear around why we're making the decisions that we're making. Then usually the next thing that we go through is reviewing tax returns. Some of my clients are doing their own taxes. Some of them have a CPA. A bunch of my clients are actually moved over to having their tax return done by John McCarthy at Advisor Facing Tax. So he and I work together to, review tax returns. He does all the tax prep, obviously. But I review the returns before they're filed and review the previous year, and then also do tax planning and projections, especially if we're planning to do some things that are different than what the client has done in the past. Like, for example, if they have a concentrated stock position, or if they never knew that they had a way to contribute to Roth IRAs through the, two-step Roth contribution method. We kind of go through, okay, what does that mean? What will that look like on your taxes? What do we have to do first? Often I'm moving pre-tax IRAs into the employer plan, into the 401k or 403b to open up the way for doing the two-step Roth contribution, things like that. So there's a bunch of tax planning that happens. And then at that point, it kind of depends on what's important to the client. Some of them want to focus on employee benefits. Some of them want to focus on college planning. Some of them want to focus on estate planning. Some of them want to focus on risk management, insurance. I have a whole list of topics that we'll cover. And for each of those, we go pretty deep into it. So we look at everything that they've got. I have some educational materials that I kind of teach them about what is estate planning, what are all the decisions that you have to make, what are the pros and cons of each one, things like that. And so it's kind of modular. And originally I wanted to have kind of like a very specific process that I would follow with each client. But what I've learned over the course of 3 years is you kind of have to let that be client driven to some extent, because some people are really motivated. They want to get everything done, within 3 months. And some clients are like, okay, well, I have a couple of pain points and I'll do the rest of that stuff eventually, but I'm not going to do it in the first 3 months. Maybe it's, in 6 months, or maybe it's in 9 months. And eventually we get there with everybody. But each of those modules is, fairly involved in terms of, education, discussing pros and cons, figuring out the strategy, and then going to implement the strategy.
So for this, this is a really comprehensive service. So you mentioned earlier having a minimum fee of $3,000 a year, I believe. What is your current fee structure that, new client comes in the door? How are you pricing services for them?
So I have 3 different services. One of them, which is the one that I prefer, is what I call, kind of full service, where I do comprehensive planning and investment management for the client. That's where the majority of my paying clients are. And for that one, I charge a relatively high engagement fee. So, as I mentioned, I do spend 30 to 40 hours with the client during the first 6 months or so. So, my ADV in my website says that can range from $2,500 to $7,500, and that's depending on complexity. Most of my new clients have been paying in the $3,000 to $5,000 range for that upfront engagement fee. So they pay that right when we start working together. And then on top of that, I basically have 4 tiers right now. The tiers are $3,000 a year, $5,000 a year, $7,500, or $10,000 a year. And those are basically buckets based on, I've chosen to do it based on total portfolio value. So that includes all of their market investments, whether or not I'm investing them directly. And
because you're advising on them.
I'm either managing them or advising on them. So, and the buckets are pretty big. So it's like 0 to 750,000 is the first bucket, and then it's 750 to 1.5 million, and then 1.5 to 2.5 to 4, and then I have custom pricing above 4 million, which I have a couple clients in that category.
Okay, so you've sort of tiered. It's like tiered flat fee based on total market assets. That's correct?
Yeah, and I would love to do it based on complexity, but I found that it's really hard to communicate with clients about complexity.
Yeah, because it's so easy to be like, oh, well, why am I this complex? What about this one thing or this other thing? I'll be simple here.
I'm basically using this total portfolio value as a proxy for complexity. And, I found that I feel pretty good about what that does for what my fee is for the client. So it's probably pretty close to the fee I would have picked if I was doing it based on complexity anyway. I may change that at some point, but for now it's working. So that's what I'm going with.
Okay, that makes sense.
And then I have 2 other services. So one is where I do the full comprehensive planning, but the client handles all of the investing. So I'm not directly managing any assets. For that one, I still have a minimum fee of $3,000 a year. And then as they get to the higher tiers, I give them a slight discount, like a 20% discount off of the full price, just because it is a little bit less work for me to not have to handle the compliance aspects of managing the investments. From a time perspective, it's not any less time for me, because telling the client what to do takes just about as much time as doing it myself, if not more. So I don't really prefer that model, but some clients really just want to still manage, like have direct control over their investments. And I really don't feel like it's rocket science. It's not something that only I can do. So I want to kind of offer that service for people who, really feel strongly about that. But as I said, it's a very small number of my clients at this point. And then I also have I used to do hourly projects. I've kind of moved over to these, what I call fixed term projects. So I basically have 3 different kind of price points for that. One is like, up to 3 hours, up to 7 hours, and then up to 15 hours. And each of those has an expiration date. So I just kind of estimate how many hours I think it will take to do work. And then if it ends up being more than that, then we'll have to sign another package at that point. And the reason I did that is because it got to be a pain to track hours and bill on hours. I just didn't want to do it. And also I wanted to have kind of if I'm going to have a project engagement, I wanted to have a minimum amount that I was being compensated for it, because it's just not worth all the trouble to do 1 hour of work.
Right. How has that fee structure changed? So I'm trying to remember where you were at when you and I talked 2 years ago, but I guess how has that evolved over time?
When I first started out, I had something kind of similar, other than like my minimum was lower. So I was charging $1,800 a year for planning. So that's, $150 a month as opposed to $250 a month, which is now my kind of current baseline. And then I had an add-on for investment management. And I also had a just kind of pure hourly model at that point. So I did increase that from $1,800 to $2,400 after the first year. And then I think maybe halfway into my second year, or was it then? Yeah, I think it was about halfway into my second year, I increased that minimum for $2,400 to $3,000. And then just kind of said, I mean, originally, if they were planning only, then it was $1,800 no matter what their assets were. But I found that I wasn't wanting to take on those engagements for the more complex planning clients, because as I mentioned, like 80% of the work is in the planning, right? So I changed that to also scale up my fees for the planning only, not just for the planning plus investment management.
Okay. Makes sense. So one of the things that you had mentioned to me in the pre-call was that you had pulled your numbers together. So I'm excited to dig in a little bit. You've taken an intentionally slower growth route than you could have, but also you're not, underpricing your services and working for free. So, well, I guess you are for a few family members, but that's it. So how has, you started 2016, you're 3 years in, how has your sort of revenue growth and expense growth looked over the last 3 years? And does it sort of fall in line with, I guess, the expectations that you had coming into it?
Sure. So as I mentioned, I do have a bunch of family members who aren't paying me. And if they were paying me, I estimate that, they'd be paying me $30,000 to $40,000 a year in revenue. So I kind of, when I look at my numbers, I kind of mentally add that to, what I would be making if I was really charging everybody what I should be charging them. But my first year, 2016, I had a total of about $34,000 in revenue. My expenses were $12,000, so my profit was $22,000 in my first year. In my second year, I had about $53,000 in revenue, so increased by about $20,000. My expenses actually went down, so they were $11,000 instead of $12,000. So my profit was $42,000. So it went from $22,000 in my first year to $42,000 in my second year. And then this year, do you want my year to date or what I project for the
year?
Yeah,
just go with projection. Just
yeah, my projected for the full year is about $75,000 in revenue, expenses about $10,000 for like a profit of about $65,000. So if you look at it from a profit perspective, it's been increasing by about $20,000 a year. So 22 to 42 to 65 over the first 3 years. And then
expenses haven't really risen.
Yeah, my expenses haven't risen. I mean, my biggest expense is my XYPN membership. I work out of my home and I really don't have very many expenses. So I've been able to, I've done some client visits, some travel, that kind of thing that I've been able to write off. But other than that, I really just don't have very high expenses. So I'm running a pretty lean business here. New clients are pretty much all profit at this point.
So you mentioned earlier that you have been focusing on, or that a lot of your clients, I guess, are Intel employees. I mean, would you consider that your niche? Is that your target market is working with, people that are currently employed at Intel, or is it broader or a little different than that?
Yeah, I would say that I have kind of a dual niche at this point. So, the biggest kind of cohorts of my clients are Intel employees and retirees. So the majority, like what I'm shooting for new clients, is that they either fall into one of those two categories or they have some sort of personal connection to me. So I'm not going to turn away, like an attorney who's a friend of mine just because they're not an Intel employee or a retiree, but I'm not really attempting to take on new clients that aren't in that niche unless I already know them or have a personal connection to them. So what I do for many of those people who come to me is I help them find somebody else if they're looking for somebody and they don't really fall into one of those two niches.
So you mentioned earlier in the episode that you do work with a lot of Intel employees. So is that your primary niche or the majority of your clients? Or I guess, how do you define your target client and sort of where do most of your clients fall?
Yeah, so most of my clients at this point are in one of two categories. So either Intel employees or people who are already retired. I do have some clients who are professionals in other fields like attorneys, physicians, teachers, etc. But most of my clients at this point are in one of those two kind of cohorts. So the way that I think about it is that when I'm looking at taking on a new client, my preference is to only take on new clients who are either Intel employees or retirees, unless they have some sort of personal connection to me. So I would still consider taking on somebody who, was in another field, professional or whatever, as long as they have some personal connection to me. But if not, then I usually try to help them find another advisor that would be able to work with them instead.
So how do you end up with those two niches? Like Intel employees makes sense, work there, the people there, but retirees is a little broader and I just feel like very different work. So I guess, how did you end up in that niche?
Well, a lot of my initial clients are retirees, so my family members. And then, like, of my first 18 clients that I mentioned, a good chunk of those were already retirees. So I had to learn all of that information about, how to handle retirement income and safe withdrawal rates and RMDs and everything related to retirees anyway. And so when new clients came up that needed that sort of help, I was able to sort of connect with them and talk with them about the work that I'd already done for retirees. I'm not out there, marketing, looking for retirees, but if they come to me, I feel like I can offer them a good service.
So where are these clients coming from at this point? I mean, obviously you're not trying to grow by 5 clients a month, but you still have to go find these 5 clients a year. So how are these clients coming to you at this point?
I don't actually go out and try to find any clients. They all are kind of incoming inquiries. The majority of them are coming as referrals from existing clients. I also get some referrals from other planners. I've had a couple of people contact me after listening to my original XYPN radio interview.
Really?
Yep. And then I've got some kind of center of influence people who send me clients as well. So, and some of them are just my personal network. So as I mentioned, I do still work at Intel part-time. So, and my colleagues there know what I do. So some of them from time to time will just reach out to me. And whenever they do that, we already have a personal trust relationship built up from having worked together for so long. So and my service is so targeted and specialized at exactly what their problems are that they basically become clients almost instantly in that case.
So what happens? I guess this is sort of circling back to capping it. I mean, what happens if 3 clients show up next week and, are you just sort of structuring out on, I'll take one in Q1, one in Q2, or do you have another way that you're planning on sort of managing that?
Yeah. So for a while, I did have a wait list where I would tell people my next opening is in this month in the future. And you can either wait for me, or if you prefer to start immediately, I can help you find somebody else. And some people wanted to start immediately and I helped them find somebody else, and some people were willing to wait. At this point, I don't have a wait list, so I can, take on a new client if they were to come to me. But that is how I would handle it. So if I did get a flood of new clients or new prospects who wanted to start immediately, I would just tell them my next opening is, February or May or whenever it is, and then we could take it from there. Because I'm really very committed to this, no more than one new client per quarter cadence, just because I spend so much time with new clients.
Makes sense. One of the other things that you had mentioned in the pre-call and just, sort of us having conversations was around some of the work that you've been doing around charitable contributions given the new tax law. So can you give me some more details and sort of fill me in on, I guess, what one, maybe there's some listeners that don't know what changed and why this became a more, interesting topic of conversation, and sort of what you've been doing given the new tax law changes that's been benefiting your clients.
Sure. So as you know, at the end of last year, a new tax law was signed by Congress. And as a result of that, the way that charitable contributions work from a tax perspective changed pretty significantly, primarily because, most clients who were itemizing no longer will be itemizing going forward. So continuing to make their charitable contributions as they had been doing is no longer necessarily beneficial to them from a tax perspective. So during the run up, kind of towards the end of last year, I was doing a bunch of research on what will this mean for myself and also for my clients, and ended up reaching out to a handful, maybe about a quarter of my clients who were already charitably inclined, so already making significant charitable contributions every year, and suggested that they consider donor advised funds. So actually was able to get, I believe it was 6 clients set up with a donor advised fund before the end of the year, and transfer appreciated stock into those donor advised funds to then, get the actual tax deduction for last year when they still could get it, and then be able to make their donations from those funds going forward for the next, either 1 year, 2 years, or 5 years, or whatever made sense for that client at that time. So that was one of the things. Also, for my clients who are retired, who are taking RMDs from their IRAs, it's actually more beneficial for them to make their donations using qualified charitable distributions, which is where they make the donation directly to the charity from their IRA in lieu of taking their RMD. So this is better because it comes directly off of income and even AGI instead of coming back as a deduction on the Schedule A. And especially since they're not deducting, they're not itemizing anymore, it doesn't help them at that point. So depending on the client, I was able to, kind of propose one or the other and then get that implemented, either before the end of last year, if it was a donor advised fund, or actually implementing it this year with my clients for those who are retired.
Very cool. And again, but it's the beauty of having a niche and having, a client base that's all around that's many of which are experiencing sort of the same issue, because then you can really deep dive, become the expert. There are a lot of advisors out there that don't need to know about all the intricacies of donor advised funds and how they work and all of that, because they're just not working with those types of clients right now. And that's totally fine. You can't know everything. So you're 3 years into the business. What, let's look backwards first. So looking back, what would you say have been maybe one or two of the biggest learning moments and things you've experienced, things you've learned, how you've grown to be that, listeners would be able to benefit from? What have you learned in these 3 years?
So I started my firm without having any previous industry experience. So I had to kind of build things up as I went. And I think what I've found really helpful is to have a specific kind of process for each type of advice that I want to give, but then kind of be willing to customize it depending on what the client needs. So my service has definitely changed over the course of the 3 years, just based on questions that come up with clients or situations that come up with clients. And I think as far as learning, it's just a question of kind of remaining open to pivoting and changing direction. And just because I did something one way with my first 5 clients doesn't mean I need to do it that way with my next 5 clients. And just kind of being aware that, things will change over time. Nothing is static, and the world changes and client changes and I change. So there's different things that, will kind of change over time. It has really helped to sort of have groups of clients that have the same issue as you mentioned, because that way I'm able to do some research, learn about something, and then apply it to a group of people. Like, for example, Intel has a deferred compensation plan, which a couple of my clients became eligible for, and then a couple of my new clients that I took on after that were already eligible for. So I was able to do a bunch of research analysis, figure out, what my advice would be around that particular deferred compensation plan, and then apply that to, when I got a new prospect who was eligible for that, then immediately be able to have a conversation with them about the pros and cons of using it and how it made most sense to use it, if that makes sense.
Yeah, I mean, and I'll say, I think it's underappreciated advice is that perfection really is the enemy, because we all think like, okay, when I roll out this checklist or this process or I do this thing, I have to do it this way for all of my clients going forward. And it's just not the case. You can roll something out, you can try it. You can try 3 meetings instead of 2. You can change the agenda, see how it goes. And you're constantly iterating. These things should never stop iterating. And I think that that's what slows a lot of advisors down is a fear of doing it wrong, as if it's going to be wrong forever. And it's just like, hey, it doesn't work in this meeting and it doesn't resonate well. That's okay. Just move on and see how things change and see what else you can work through.
Right. Yeah. The other thing that we didn't really talk about was since I do have fixed fees, I'm not charging based on AUM. I do have to go through and update client fees from time to time. So I started going through that process this year. I basically, at the 1-year mark, I will mention to a client that they can expect to see an updated fee at the 2-year mark. So that's my process. And then at the 2-year mark, I contact them and I say, okay, well, if you were a new client, this is what you'd be paying. This is what you're currently paying. And here's my, new proposed fee for you. So in some cases, it goes all the way up to what a new client would be paying. In some cases, if it's a, radical jump, I might do it gradually over a couple-year period. So I've gone through that with kind of my first cohort of clients, and the conversations have gone well. Almost all of them have, stayed on at the higher fee. I did have one client drop off, but it probably made sense for them to drop off anyway, because the type of help that they really needed at that time was more around cash flow and budgeting, which is not the kind of thing that I really focus on in my practice. So it kind of triggered that conversation and probably made more sense for all of us for them to move on and find somebody else at that point.
Makes sense. Yeah, that's a tough conversation. And it's one that, when you are flat fee, you have to have that conversation every couple of years, if not every year, because your income, your revenue isn't just going up as your clients save more money as markets go up. It's why AUM is so popular. It's because your fees increase automatically without having to have a conversation with your clients. But it's okay to have that conversation. I mean, we're starting to talk with advisors around. Do you just put in an auto escalation of fees into your contracts? What does that look like for just go up by 3 to 5% every year, or is it an assessment every 2 to 3 years based on net worth? Since your fee structure is based on something, and it is based on that net worth or the investable assets number, like that can change over time and be reassessed. So
sure. And because I'm not pulling fees from accounts, I do actually need the client to sign a new agreement and agree to a new amount, because they have to initiate the pricing change as well. I can't just automatically start pulling a different amount without signing a new agreement with the client.
So looking forward, I guess what's coming down the pike for you? That you're growing as fast as you want to be growing. Things sound like they're going good. I guess what else are you going to be working on over the next 12 to 24 months?
That's a good question. I'm always trying to improve my my process and my workflows and things like that. I use Asana for all of my task tracking and workflows, and I'm just always building that out to add additional, workflows and keeping track of everything there. As far as clients, as I said, I'm looking at taking on either 0 or 1 new client each quarter. I really do enjoy working with new clients, but I'm also totally fine just continuing to work with the client base that I have. So in terms of going forward, I think the most important thing for me is just to continue to enjoy the work that I'm doing and feel like I've got the right balance between work and travel, spend time with my family, time with friends, and so on, time for myself. I don't think I mentioned, but last summer we went on a 6-week road trip and we drove across the country, my husband and my 2 kids and myself. And it's really important to me to be able to do that type of thing and have that fit into my life and my business and things like that. So for me, it's mostly about balance and enjoying the work that I'm doing, enjoying helping the clients that I'm helping, and kind of growing if it makes sense. But growth is really not my goal at this point. It's really just more about personal fulfillment, feeling good about the work I'm doing, and obviously making sure that my clients feel good about the work I'm doing as well.
Makes sense. Well, Linden, thank you so much for taking the time to come on the show and give us all an update. It's exciting to hear how things have evolved and progressed for you. And, I'm excited to see how the next year or two continue to do that for you. So thanks so much.
Yeah, thank you.
XY Planning Network's annual benchmarking study is out. Are you curious about the average number of clients XYPN members get in their first year, or how successful niches really are? To answer these burning questions and more, we've again enlisted a professional research firm to complete our annual benchmarking survey. Get your copy hot off the press and discover vital statistics such as the median advisor revenue by years in practice and sources of firm growth from referrals to blogging, social media, and more. Head over to xyplanningnetwork.com/study to purchase your copy. Be sure to join our VIP community at xyplanningnetwork.com/VIP to hang out with other XYPN radio listeners, ask questions for future mailbag episodes with myself and Kitsis, and to finally find a community of like-minded financial advisors. Thanks so much for joining me today. We'll see you next time.
You're not alone, and you're not crazy. It's scary starting, building, and growing your own financial planning firm. And that's why we put together a free private community just for you, the Cutting Edge Financial Planner. Go to xyplanningnetwork.com/VIP or text XYPN Radio to 33344 and join a network of thousands ready to change the lives of Gen X and Gen Y clients.